Hello, ladies and gentlemen. Greg McCloskey from ForexLive.com. This is a Forex quick look. I'm going to take a look at the dollar versus Canada. Today's date is October 30th, 2024. Let's get started. Looking at this chart, there are a couple levels in play. One is this high right here. The other level is this high right here, the more recent high. This is the high for 2024. And that level comes in at 1.39458. This level comes in at 1.3977. And our high price today got within 7 pips of the 45 level of the high price from 2024 and rotated back to the downside, currently trading at 1.3916. So a new high averted. Sellers leaned. The price rotated a little bit to the downside. But overall, taking a look at this move to the upside from the end of September high to the high price toward the end of October, quite a bit of a trend move this month in the dollar versus Canada as the markets react to the Bank of Canada cutting rates by 50 basis points. Also expectations of more cuts ahead, slower economy, and even though the employment statistics at the last month came in stronger than expectations, market's still expecting that there's going to be further weakness down the road. Not to mention things like extraction of commodities is an issue, housing remains an issue, so on and so forth. So that's helping to drive this pair to the upside from the Canadian standpoint. And of course, then we got the U.S. standpoint, which had stronger growth in the month of October, generally speaking. So fundamentally speaking, the sellers or the buyers are in firm control. What would give the sellers some hope? And that's where you start to look at levels on the downside that need to be broken in order to increase the bearish bias. What I mean by that is that if the sellers cannot get below certain technical targets on the downside, certain levels that may be of interest to both buyers and sellers, then they aren't winning, folks. The buyers continue to win. And so when I look at a chart, I try to use tools that the market pays attention to, like the 100-hour moving average. Here at the 100-hour moving average, we found support buyers, and then we fell below the level, and we saw buyers turn to sellers. We moved back above the level through here, and we found support buyers, and then the price moved higher. Over here, we came down to the 100-hour moving average, moved below that level, but found support buyers against this swing area right here. And what do? We moved back above the 100-hour moving average, and the next time we tested the 100-hour moving average right here, we found early support buyers against that level, and the price moved higher. So guess what? The 100-hour moving average is going to be a close risk level for the dollar versus Canada. If the price is able to get below that level at 1.38877 and moving higher, then that would give the sellers some confidence. That would give the sellers some level that they could define risk against. If you break below that level, what do you not want to do? You don't want to see the price move back above that level by a certain amount. Use some sort of 10 pips or whatever above the 100-hour moving average as your stop, in hopes that the price is instead going to correct what has been a pretty decent run to the upside in the month of October, going back to around the September 24th low right there. So that is what traders will be looking for until the price moves back below the 100-hour moving average. Are the sellers winning? No, they're not. They're still losing, and the buyers are still in control. So watch that 100-hour moving average. That's going to be the key level, not only today, but going forward as we head into more volatile times, led by economic data, led by the Fed, led by the election, led by other fundamental news that's going to come out, including earnings that might have impact on the U.S. dollar and in turn the dollar versus Canada as well. So that's my technical look at the dollar versus Canada. My name is Greg McCloskey. Good fortune with your trading. Bye-bye now.